So I'm going to look at an excerpt from the market commentary in our recent 2025 Cash Rich Profitable Canadian Small Cap Report, and just go over that generally right now. The Schiller PE is a general market valuation indicator that we use for a general overview of current market valuations in a historical context. We use the Schiller PE. Professor Robert Shiller of Yale University invented the Shiller PE ratio to measure the market's valuation. The Shiller PE, it's a more reasonable market valuation indicator than the PE ratio. It eliminates fluctuations of the ratio caused by the variations of profit margins during business cycles. This is like a market valuation based on the ratio of total market cap over GDP, where the variation of profit margins does not play a role either. Okay, well, let's just look where the current Shiller PE is now. 37.9, that's 41.8% higher than the recent 20-year average of 26.7. To put it in context, the 20-year low is 13.3. The 20-year high is 38.6. Now, this is a chart of or a graph of the Shiller PE on the S&P 500 all time over 100 plus years, as we can see there where we are historically. Well, the Shiller PE is not at an all-time high. It is currently at or near the top three levels all time, indicating the markets are generally expensive on average. Here we can see that the ratio, this is over the past 10 years and where it's basically trading at 10-year highs today. So I'm going to also present some additional data here, points indicating the S&P 500 is historically expensive on average today. Number one here, I'd say the S&P 500 currently ranks in the top 1, 2, or 3 in terms of price earnings ratio, price to sales, price to book, and dividend yield metrics over the past 60 years. The 12-month trailing PE ratio of 25.5 is the fourth highest since 1954. The price to sales of 3.3 is the highest since 1990. And the price to book ratio at 5.3 is the second highest since 2000. The dividend yield of 1.23 is the second lowest since 1970. So some additional data points there showing that the S&P 500 is certainly not cheap today. I'm going to give some final thoughts here. While we continue to uncover, and this is from the report, and monitor many great Canadian and US small cap businesses, the combination of quality, growth, reasonable valuations, and strong balance sheets and strong businesses has narrowed considerably. The primary culprit of this has been rising general markets, which saw the S&P 500 jump over 24% in 2024, and the S&P TSX was up over 18% in the same period. As detailed in the commentary that I just went through, the general gains have pushed valuations to the high end of historical norms, giving Keystone reason to be cautious in the near term and continue to just monitor for entry points rather than jump in and introduce new quality names at elevated valuations or take undue risk on more speculative names at, say, a decent but riskier valuation. Well, the potential here for a Santa Claus type rally to start 2024 with the promise of tax cuts boosting U.S. earnings under Donald Trump. The general market environment at present, which does include potential tariff wars, uncertainties within Canada and the U.S., potential inflationary pressure, slower economic conditions, and high historic valuations, like I went through, should tip the scales for investors into a more cautious stance in the near term. Overall, there are a number of quality stocks that we would like to buy at some point in 2025, but given the above, we require significant pullbacks in a number of these names to enter with a reasonable margin of safety. In fact, we have a U.S. small cap service that we're looking to launch and several stocks we've identified as quality long-term businesses, but continue to monitor for better entry points. It's certainly not as easy to find. We talked about these two companies from last year that we were able to identify ending 2023 into 2024, VitalHub and Cipher Pharmaceuticals, companies that trade at very low valuations at that point with net cash, good businesses, companies that have done tremendously well over the past 18 months. Certainly more difficult to find those type of companies today. But we are finding some value, and we're going to come out with a report over the next 2 weeks for our Canadian small cap clients on new top recommendations for 2025. Difficult to find companies that go up 200 to 300%, but are there still some companies that look 50% undervalued? Yes, there are. You just have to search a little farther today.
Yeah,
Right.
exactly. A couple of unique situations and interesting businesses that we've been interviewing over the last few weeks. So yeah, clients will be able to look forward to that.
For sure.
You know,
Okay.
one of the things that I just want to mention is that with the Schiller PE there, how it was intended to be used. Like a lot of people will look at that as, well, the valuation is high, so does that mean I should get out of the market? But Schiller actually never intended the metric to be used like that. But what he did find is that there was a relationship, an inverse relationship to valuation and future returns, like long-term returns. So, for example, when the valuation is high, it's more likely that the average return over the upcoming 10 years would be lower. So right now we have a high Schiller P ratio, historically high Schiller P ratio. And what we're seeing is, for example, Goldman Sachs, they made a prediction where they're expecting average returns for the S&P 500 to be 3%, basically on average over the next 10 years, which is obviously minuscule compared to what they have been, right? So that's really the way to look at it. One thing, if you're going to try and do market timing based on the Schiller P ratio, like say get in and out of the market, you already would have been out of the market many years ago and you would have missed all of these historic returns. So don't do that. Another thing is when Goldman Sachs makes a prediction about 3% average returns over 10 years, that's just the average. But over that period of time, you could actually experience a period of very high volatility where stock prices and valuations go up and down. And that's really where the opportunity is for stock pickers, particularly small cap stock pickers, but potentially any stock pickers, to do research and find opportunities to buy great companies when they do come down. So even in an environment like that, for an individual stock picker, there are still great potential opportunities.
Well, everybody thinks they make their money in an up market. You realize the work that you've done in the up market. You can realize those gains, but the real work is done in a down market or when markets are flat, depressed, and you find good companies that you can own for the next bull run. And we're always looking for new companies or monitoring existing companies to try to find good companies that'll be the next 10x stock over the next 10 years. That's what we're trying to do, looking for good quality business. We don't stop the research when markets are too expensive. We don't run in fear when markets are too look cheap. That's when you actually act on those companies that you've been monitoring for the long term.